me off in the background, and they're saying, hey, there's no sound, there's no sound. And so for whatever reason, our Restream company, we contacted them, and they said, hey, sorry, we had some tech issues. Boy, isn't this the time? Your cell phone's not working, your internet at home is not working, and it's become the new norm of, oh, sorry, the technology failed, so I want to apologize. So here's what I did this week. I actually threw some additional things in. I kept some things last week that a lot of people said, hey, I watched the broadcast and I really want to know about what you were saying on this particular screen. So I brought some of that stuff back in addition to giving you the updates that we need for this week. So let's just jump right into it. So this week, big changes. We got some unemployment, Fed decisions, interest rates and housing inflation, and stock market indexes. So if you've joined me at any time in the past, you know that I built out an economic map back in February of 2020 to kind of outline exactly what was going on, or what I perceived was going on within the market, and so that we could start tracking things. And if you remember, as I said before, we started off here in February with this disbelief of what was happening with the market. But we've talked about how the institutions, they buy big data. That's where they scour the internet and they find out what's going on, what people feel, how their emotions are. And those institutions are trading against you. They are the enemy. They are the ones that are putting this false media out there about, wow, the stock market is going to go to the next crash, or all the currency in the United States is going to go away and it's all going to be replaced with Bitcoin. And people start freaking out. I mean, they just say, oh my gosh, what's going to happen to my cash? Listen, bottom line is I'm going to actually put together a separate presentation, a separate broadcast about this to show you how much fake media is out there, where it's being produced from. But that is generating and it's trying to motivate you to make a decision that they're trading against. Well, that happened, and consumer fear jumped in and they started selling, and then all of a sudden you see that stock market just bottom. It just dropped like a rock, right? Well, this is when I came in and I said, listen, once the virus levels out, and we still don't really have a complete leveling out, we're going to see spending spree and confidence. Well, we saw this the minute that they pre-opened some of these states. People went crazy. What do you expect? We're Americans. We're not expected to stay in the house and not enjoy life. We're the biggest per capita spending country in the world, right? So we want to spend money. We want to go enjoy and have things. And just, this is what our culture is, right? We're not a European culture that lives in the mountains, that, we get 3 pieces of bread every day, and man, they're grateful for that. That's their culture. I respect that. That's just not Americans. That's why I said when this opens back up, man, it's going to burst. But what happened, and I also predicted in here that in sometime in around September, October, we were going to see a real big pullback. Well, I'm going to delay that a little bit, but again, we have this election going on this year, and this is going to cause all kinds of problems within the stock market, and especially when it comes to the taxes that we see coming in. The taxes really, originally I predicted that they were going to happen out here in 2022, but now with this second round, I'm predicting that they're going to happen probably right at the beginning to the middle of 2021. Also, if you look over on the side here, I've made some predictions based upon the algorithms that I'm reading about what Biden's tax plan will be, about reinstituting estate tax, raising the personal income tax, changing capital gains tax rates, increasing corporate taxes, and the worst one, which I saw, was actually creating a federal property tax. So you think you're already paying enough to your state and property tax? Well, they want to recover that money, and they want to do it quicker under Biden's plan, which is a proposed federal property tax bill. And so I also estimated here that housing was going to take a big crash. Now, I'm going to start extending that based upon what I see, what happens with Congress with this second stimulus, and upon what those details are as far as what they're going to do with rent extensions, forbearance extensions, how they're going to handle the banks taking some of these extensions. Last week I did talk about this Bank of America article that I read about this lady who called in, in April. She was a nurse. She had lost her job, so she calls into Bank of America and she says, hey, look, I'm having some tough time. And they said, sure, we'll delay or defer your mortgage payment. And then all of a sudden, 2 weeks ago, she gets a bill because it was a 3-month deferral for $4,500 from Bank of America. Well, her monthly mortgage payment deferred was only 3 months, and that was $900 a month. You do the math, you're like, where's that extra couple $1,000s coming in? Those are fees, expenses, and penalties. Well, they deferred it, all right. They'd agreed not to foreclose, but they, in all the small print, they didn't tell her all the details. And honestly, we've all done this. We've signed on to a website and it says terms and conditions, and you open it up and it's 40 pages. You're like, okay, well, how bad can it be, right? And you just click on it. And unfortunately, this is what she did. And she said, I never agreed to this. I thought that this was going to be added on to the end of the mortgage. And Bank of America said, well, that might have been what you were told, but the contract that you signed is a little different. So we have no idea what this is going to look like. So I think we do need some better protection by the feds. Sometimes I feel like we need to be protected from the banks and some of the things that the banks do, not necessarily in an evil action. I don't believe that, but I do believe that sometimes it gets so complex that sometimes the consumer doesn't know what they're being offered, and they just sign on to it with a belief that this is what it is. A great example of this is we reviewed something for a client where they had bought a RV, and the RV had all kinds of problems, so they went to a lemon law lawyer. Well, the lemon law lawyer sent them a contract. And I'll be honest with you, I've never reviewed an agreement, a legal agreement, a retainer agreement from a law firm that advises that you hire outside counsel to review the engagement agreement from the law firm. I've never seen anything like that. But anyway, this is coming from a law firm who you think you're hiring them to protect you. You're hiring them. They're supposed to work for you. But I was very interested in the contract, and I called the client. I said, listen, I don't understand this. I said, so what they're saying is you have to accept any offer from the manufacturer. Otherwise, you have to pay the legal fees. So this particular client had about $175,000 into this RV. And unfortunately, what happened was there was all kinds of problems. And I said to the client, I said, listen, that means that the manufacturer could come back and offer you $120,000 to take back this RV, and then your legal fees are $25,000, and you're out, $70,000, $80,000. So again, sometimes it's not evil out there, but it's really just understanding what you are signing on to. So again, the banks, you got to be careful of this. So the hot spots, as you can see now, they are pretty heavily concentrated on the East Coast in those denser areas. You'll see why this will affect some of the real estate prices and what we're going to talk about with housing. As you can see on the West Coast, it's not quite as bad. This is updated as of August 6th, by the way. You can see in some of the most populated areas in the Washington area, the Los Angeles area, they're extremely, extremely heavy, even in the Denver area. So the virus vaccine update, well, there's one company approved for limited use. Now I'm kind of keeping track so you can see where we're going from 1 week to the next. We have now 6 companies in phase 3, which is the final test, 12 companies in phase 2, and 18 companies in phase 1. We have 135 companies in preclinical trials. That means not ready for human testing yet. Who are the vaccine leaders? Well, we've got Pfizer and BioNTech enters into phase 3, and they hope to have a vaccine by the end of 2020. We have Oxford, Serum Institute in India, Novavax, and Moderna. Man, I love these pharmaceutical companies. Boy, I think, what is this, respect out of hard to pronounce companies. So Moderna is probably the leader along with Pfizer in the U.S. How does that affect what we're doing within unemployment? Well, obviously, the vaccine is the economy. That's exactly what I've been saying since February. The vaccine is the economy. So we had a little bit of an adjustment of unemployment from the last week to this week. We went down from 1.4 million to 1.1 million applications last week. But unemployment, oddly enough, It's holding steady right at 11.1% week over week. Now let's contrast that to April, where there was 14.7% unemployment. And the current discussions in Congress, which I'm going to get to in a little bit more detail in just a minute, is there's a proposed $600 a week with a 60 to 70% of prior wage cap. And under the current model, unemployment reduced to not my expectations. On my current algorithms is that unemployment will reduce to 9% by the end of 2020, and that it will reduce to 6% by the end of 2021. This is now my new algorithm based upon the release of the vaccine, job cuts, unemployment, stimulus package, all the different things that are going into effect. Now, again, I do believe that we are going to see one of the biggest paradigm shifts probably since the Great Recession, the Great Depression. Some of the biggest events in our country's and world history have shifted the entire way that we do business, the way we think, the way we interact, the way we socially interact. All these different things. Work at home, we now see that Google is not going to ask their employees to come back until July of 2021, another year. Same with Facebook, and we're seeing this sign on by so many different companies. So we're going to see an entirely new industry. Anything that is work at home, it could be internet, it could be furniture, it could be all kinds of things that pop up. So we have the job adjustments and cuts. Last week, or July, we showed a 54% increase in job cuts. Job cuts are defined as business closures. In other words, it's not a layoff. It is a job elimination. This could be an airline pilot. It could be somebody at a bar that was working in a bar at a restaurant because they shut. That's a physical cut versus an unemployment. So we had, in April, we had job cuts, 671,000. May, 397,000. But here's the interesting news. July, the non-farm payroll grew by 1.5 million for a net gain of 400,000 jobs over the 1.1 million in new unemployment claims. So again, you got to look at the net number. I know that most mainstream media really likes to splash all the negativity so that you tune in. You got to look at what those net numbers are. It's no different than the financial industry. People will say, well, my financial person said that this mutual fund did X number of percent rate of return. Well, you got to look at when that started. Are you using trailing 3 years, trailing 5 years, or did they start the rate of return right after the 2008 giant housing and financial collapse? So you got to look at how those numbers are computed. Now, Congress, here's good news. Congress to cancel vacation. So McConnell says, hey, you guys are all staying until this gets done. Actually, I'm pretty impressed because the last stimulus bill, if you remember, everybody went home. It got delayed by 3 weeks. Pelosi had to jump on a plane and go back to Pennsylvania or Washington to vote, and there was just a lot of irresponsibility that was performed by Congress. And this time around, they're actually, I think, doing the right thing. They're saying, hey, we're staying until this is done, until everybody agrees to this. Trump stated that if no agreement reaching by Friday, he will evoke executive powers to extend unemployment, freeze evictions, provide a stimulus check, freeze payroll taxes. So these are all the things that are on the table. Let's go through some of those. We're looking at a $1,200 in stimulus payment for those who qualify, and that's based upon annual income, age, number of dependents. We have an enhanced weekly unemployment, again, but that is going to be based upon a cap. We don't know where that cap is going to fly. Eviction protection. And one of the things that employs, if we remember, small businesses employ about 42 to 49% of the entire workforce. And the PPP, which was slightly abused during the last release, has now it's on the table for let's say the second round. So for businesses who have lost at least 50% of revenues due to the virus, we have a return to work bonus up $450 a week for those who have either secured their return to work or found another job, and some rental assistance, and finally payroll cut tax. Those are all the things that are on the table for this change. So let's take a look at interest rates. Interest rates, Fed rates, no difference. We've already heard Powell say, listen, I am not going to abide by the 2% cap that we were anticipating on trying to keep inflation at. However, there has been a big change. Mortgage rates haven't really changed much. They haven't come down. CD rates are terrible. But we also saw, and this is what I was predicting for the last couple months, high yield money market rates drop below 0.9%. Now, housing, where do we stand with housing? Well, we have this forbearance risk, and again, I cited that article that I read about Bank of America. It doesn't mean that all banks aren't doing this kind of stuff, so you really, really got to know what you're signing, you're getting into with any kind of forbearance or deferment. Now, 2 and 5 tenants, they're due for eviction notices, and eviction protections are going to expire July 31st in 30 states unless it's renewed, which is what we're waiting for this week. We have a lapse on unemployment. Again, we have estimate of 40 million renters at risk unless they pass this stimulus bill. Now, here's what's interesting. Housing prices increased by 4.1% in June. Why? Why is that actually happening? Well, we have low inventory. Why? Listings are down and construction is down. People don't want to show houses to strangers with the possibility of infecting the house. And construction is slower just due to material and labor delays. I mean, look at now. You order on something on Amazon, you could get something in 2 days, and now it's like, well, we'll be delivered by October 15th. And, it's interesting, this whole dynamic shift. It's not a shift in just what we're seeing in jobs and economy and products. There's a shift in, we as Americans expect things like right now. We want to go to a store and get it, and we want to go online and have it delivered the next day or 2 days. And, now we're having to adjust to this, and we're becoming a little bit more like Europeans maybe, and saying, hey, I can't just order it and it's on my doorstep. Now it's like, hey, I got to wait a week. I got to wait 3 weeks, which is a very interesting dynamic for us Americans to get used to. And again, the housing prices, the jump in housing prices are due to low interest rates, and and this is what I said before, way back in March, I said, watch what happens. We're going to have this huge exodus of these major cities and moving back to the rural and the suburbs. And this includes price increases on sales in suburbs, but does not account for the stagnant sales in urban areas. So when you look at price increases, you got to look at how those numbers are actually calculated and computed. So if they come out and they say, hey, it's a 4.1% increase in housing. Well, look, if I have a condominium in Manhattan at $2 million, I've got some cash, right? I've got some money. I'm a pretty I don't know. Maybe I'm poor in New York. I don't know. But, that was probably a bad example now that I think about it, because it's probably like $1,000 a square foot there. You probably have like a little 500 square foot apartment. So let me use another example. Let's say I'm sitting there in New York City, and let's say, as an example, I've got this house, and I want to get out of New York City because of the cluster, the virus, the danger, whatever it is. So now I go to Connecticut, or I go to Montana, and I buy a house. Now I'm in a bidding war, right? But I haven't been able to sell my house in Manhattan. So this 4.1% increase is only on the new sales, but again, it's not accounting for when all these people have to start selling their other homes. So again, be careful of the numbers that you actually are reading. Now, inflation, this is one of the big ones that people wanted me to bring back because of last week's epic fail on sound. So the V begins. Inflation has started to show. We had an 8.5% increase in spending in May and a 5.6% increase in spending in June. And as I said before, people are calling in. They're saying, hey, what do we do? Well, number one offset or defense to this inflation is tips as an inflationary hedge. But again, it doesn't mean that you just pour all your money into tips. It's a matter of saying, hey, if I have an asset allocation model and I have 14 categories, and out of those 14 categories, one of those is short-term government bonds, and let's say out of those short-term government bonds, I'm splitting half of that to tips and half of that to T-notes, right, or treasury bills. Well, what I'm going to do is I'm going to not go treasury notes and treasury bills right now, but I'm going to allocate more of that to tips. And again, as I said before, Powell has kind of broken his standard policy, which we've had in place for many years, of the Fed's attempting to control inflation by keeping it at 2%. His goal right now is saying, hey, there is no cap on it, which is good. Again, I'm going back to the 1929 Great Depression crash handbook or playbook, and again, their mistake was they tried to control inflation too soon, and we went into a second recession. Well, the stock markets, they're going to hinge on the next round of stimulus today, right today, or hopefully by Monday. We're going to know what that stimulus is. And I made a prediction at the beginning of the year, and I said by the end of this year, I am predicting that the Dow gets to 30,000 points. If we see the stimulus that I think we're seeing, we might see that sooner than the end of the year. Again, but August 8th, well, they might extend through the weekend like they did before. But again, it's important that our Congress follow that 1929 crash playbook, because we watched what happened. And while that was more of a debacle of real estate, the banking system, and deregulation on the stock market, there was a lot of human psychology that was performed in 1929 that we can study and repeat, not repeat the same mistakes that we made back then. Now, however, in all my discussions that I'm talking about in every broadcast, and when I talk about paradigm shifts, I'm not talking about you going out and going, hey, I think Amazon's going to be the next big killer stock. And you do that. Focus on your cash flow and your portfolio needs. As I always say, reverse engineer your cash flow. That determines the portfolio mix. But the portfolio mix still has to follow where money goes. So, a lot of people say, well, I'm just going to buy the S&P 500 index and just, call it a day. Listen, you got to look back at history, right? The S&P 500 index is not a perfect index. First, it's market weight capitalized, which means that they're going to put more. It's not 500 stocks equally weighted. Its weighting is based upon popularity. So here's a great example. We've got this new Robinhood app that all the millennials are investing into, and they're artificially pumping up the stock prices of certain stocks, which means that the way that the S&P 500 index works means that they get a bigger weighting. It doesn't mean that they're a more valuable company. It doesn't mean they're following Buffettology rules. It doesn't mean that their valuations are good. It just means that more people are buying that stock, pumping up the price, and they get a bigger valuation or bigger percentage of the index. What I'm saying is that you have to understand how all these different portfolio levers interact with each other, and don't just take blind media as saying, well, if I just put it here, I'm going to be fine. Don't do that. And also don't listen to some of this media. I love this. The man that predicted Amazon would go to its current prices has the next big prediction. I love that. Right? Come on, really? So if he's that wealthy, then why is he out there talking about his next big prediction? And if he's that wealthy, why do you have to buy his newsletter, or why do you have to buy his secret, right? If a guy's got that big of a secret, right, he's not going to be stupid enough to tell the world about it, because then you dilute everything. Or he plays the other side of the game like Bill Ackman did with Allianz. He says, hey, I think the world is going to come to an end. He said this back in March, right? So the market reacted. He had a $27 million short against the market, and he walked away with, I think the number was like $3 or $4 billion, because everybody reacted. And then all the copycatters jumped in, soon after. They're still trying to copycat him. You see these predictions. The world will come to an end. Guys, all you copycatters, I hate to tell you, but you have jumped in after the game. Bill Ackman played the market. He played the human psychology. It's over, because anybody that's reading this garbage out there that's believing that the world is going to come to an end, or Bitcoin is going to take over currency, or all these other crazy things where people are just have an intent to sell you something. I'm sorry. Get out of the game. Go back to really figuring out valuations and money, instead of trying to convince people through fear that the world's going to come to an end unless you buy their newsletter. They're never going to survive, right? So the paradigm shift that I've been talking about is life has changed. This is evident, right? I've been doing this now 36 years, and in the last 5 major market crashes that I've been a part of, the first ones I was working with firms, and I watched how they would navigate it. And now it's a matter of just looking at how things have changed and where people will be spending their money, right? So if you look back and you said, well, there was, I always use this example showing my age. Hey, there used to be vinyl records, and then there was cassette tapes, and then there was 8-track tapes, and then there was CDs, and then there was Blu-ray. And all of that has gone away with what? Streaming, right? Why are you going to go buy a CD? I mean, no one even wants the stupid things. They just take up space on a shelf. So you have to look at how things change, and then that is where the money's going to go to. Look at Chipotle versus Shake Shack. This is one of the other ones. I get all these emails. People are like, what are you talking about, Chipotle versus Shake Shack, when the audio failed last week, right? So I thought I'd put this in there. Well, Chipotle is up 49%. Why? They heavily, day one, they put all of their effort into home delivery and internet sales. Shake Shack did not. They were late to the game. Now you see that Shake Shack is installing drive-thrus. They've upped it. Why? Chipotle was up 49%. Shake Shack was down 29%. Huge difference by just looking at the environment and where people need to spend money. So residential, look at where we invest money in real estate. Residential, people are going to be working at home. Got a good friend of mine that, we've been talking about homeschooling because we homeschool. We have homeschooled our children, and now with our daughter, we homeschool her. She's 6 years old, and our two older boys we homeschooled them, and it was the most wonderful experience and has been the most beneficial thing to them that I could ever imagine. I have touted it, promoted it, sold it to everybody. I said to Julie, I was like, my goodness gracious, I wish I got a nickel for everybody that I promoted homeschooling to. Anyway, a good friend of mine, we've been talking to him about this for about a year or so. And I just talked to him the other day. He's like, you know what? We pulled the trigger. We're putting our two boys in homeschooling. They live in California. And the interesting thing was, he goes, I don't know why we had such a hard time getting to this point. It was just this belief system that we held on to, and we just, felt like this is what everybody did, and this was the norm, So unfortunately, he's now switched over, and they're really excited about it. So again, what does that mean? That means higher home internet. It means different furniture. It means different computers, different camcorders, etc. It also means that the physical paper books that people were investing into might go away. What does that do? That changes the way that paper companies and wood companies and mining companies and lumber companies, it's all interactive. So again, we have to look at how these things change and what we have to do to adjust. Well, where are we the stock market? Well, ending 8.6. Look at this chart here. We started off on May 15th when I started tracking this and showing everybody. We were down 12.38% on the S&P 500. And here we are about 3 months later, right? We're up 3.7. But the big thing I want to bring to your attention is, look it up here. 2019, we were up 31.39%. But in 2018, we were down 4.38%. Well, here's what's interesting. You take that average of those 3 years and we're doing pretty good. Now, what I want to bring also to your attention is, look, even if we end up this year down, if we take a look at those 4 years of averages, people are still doing much better. And again, the goal is you got to beat inflation. So what do we do now? Well, the actions to take. Well, we got an RMD payback or distribution options. Again, remember, early in this game, I did a lot of webinars and a lot of broadcasts on the advantages of taking the money out of your IRAs or profit sharing plans or your 401ks. But remember what I did, and if you haven't attended these, for the last few weeks, I've been warning everybody, listen, the Congress changed those rules, IRS changed those rules, so you may not be eligible. In other words, you may have taken an accelerated RMD or a loan from your profit sharing plan or 401k. However, they changed the rules as to who is eligible and who is not. Hey, welcome to Congress. If you can't justify your job by changing things weekly, then you'd have to go back to a real job. So you got to be careful. And that's really what we're here to do, is to make sure that we are keeping up on these things and keeping you informed. And if you're a client of ours, actually making those changes. Number one, rebalance. Please rebalance. Get those portfolios in alignment with the new paradigm shifts, with what's happening with the economy. I don't know if you've had any tax loss harvest. We were doing this heavily back in March and April. But now the market is so far up, you might have missed that opportunity. But strategic distributions. Now what we're looking at is, look, if somebody has a huge capital gain, what does that look like towards the election? If that person has a gain going into next year and the capital gain goes from 15 back to a top rate of income tax, which could be 40%, should we just take those capital gains right now? And again, that could also have an effect on the market the closer that we get to the election. Not just the potential tax change if Biden wins, but also the massive selling to capitalize on capital gains at a lower rate. Again, change in direction on paradigm shift. Refinance the home. Do it now. Do not wait. Please, please, please do not wait. Why? Because your appraisal may go down if the housing market crashes, and you may not be able to get out or at the rate that you're at now. Sell your home if you're in a high growth. We've been recommending this to people at least while this bidding war is going on. Get rid of the house if you're like Julie and I. We sell our houses when they're at the top, and then we rent, and then we buy back. We did it in 2008, and it worked out very well. Again, you just have to be willing to be mobile based upon what the market is. And again, prepare for that real estate buyback in 2021. Don't just go back and rebuy something right now. And restructure your trust in your family protection plan. Also, look for these changes. I've been warning people about this. The Social Security changes are coming, and they're going to hit those retirees. And unless you have somebody that's navigating those waters for you, you could really get destroyed. Election protection strategies. Again, this is something that we're following literally on a daily basis. And unless you are really understanding what the proposals are, those proposals from both of the candidates will then convert into what we would do with the portfolios, our tax planning, etc. And again, as I stated at the beginning, I'll send it again, because what I find sometimes is people will call into the office and will say, I never heard of that. So I'm going to put it in big neon, flashing, alert signs. Listen, if you have taken money from your IRA or under the 401k under the CARES Act, you better make sure that you meet the new requirements. Otherwise, you will pay penalties. And hey, look, if you are dealing with a bank or a brokerage company, or I love this, the person that says, I'm a fiduciary advisor. Ask them when they act. Are they fee only, or are they fee sometimes? And I just read this story. It was very interesting. Before I wrap it up here, a guy goes to see this financial advisor and sells him whole life insurance. And so he gets a second opinion. He goes back. The second opinion was from a fee-only advisor. Says, I can't justify you buying that whole life insurance because of the commissions and the terrible returns. So he goes back to the original advisor and he says, listen, I was told that I should work with as a fiduciary. So then the advisor comes back and says, well, I am a fiduciary. And under the new Certified Financial Planner Board rules, they've gotten rid of the difference, even a search on their website, of whether you're searching for a fee only or a fee sometimes, meaning that you will work with somebody on a fee and then sometimes they'll work on a commission. So they actually got rid of that because the board, the Certified Financial Planner Board, now believes that there really is no difference. I do not agree with that. I agree with that the commissions will motivate the recommendations. So if you deal with a fee-only advisor, then what you're dealing with is somebody that's saying, basically, I have no gain by recommending one thing over another, versus the whole idea of, you go to an advisor, he says, yes, I'm a fiduciary. Here's the second question you ask. Are you a fiduciary all the time, or are there ways that you make commission on some of the recommendations? And I have a problem with that, because it would be like me going to a doctor. I have to trust that the doctor's recommendation and his recommendation of a prescription is going to be the best thing for me with the least amount of side effects, right? But if that doctor has 50-50, sometimes he can recommend a prescription and he'll earn a commission, or he can recommend something that he doesn't earn a commission on. Well, now I just want to know, right? That's all I want to do, is I want to know. Now, thank goodness that the doctors can't do that. But what I'm saying is, if you do deal with somebody that is a bank, brokerage company, a money manager, something like that, call us. We'll give you a second opinion, and call us. We'll actually tell you if they're truly a fiduciary or not, working always in your best interest, or are they working both sides of the game. Hey, with that in mind, I'm going to call it a day. Enjoy your weekend. We're getting to the end of the summer here. We're going into the election. We got a lot of things happening, so make sure you join in every Friday at 4 p.m. Pacific time, and this way you can stay in the